Welcome to a journey that will change the way you think about wealth creation. Today, we're diving into the power of compound interest, a force so mighty it can turn small investments into substantial fortunes. Have you ever wondered how the rich get richer? It's not just about earning more money, it's about making your money work for you, and that's where compound interest comes in. Compound interest is like a snowball rolling down a hill. It starts small, but over time, it grows bigger and faster, accumulating wealth at an exponential rate. But here's the catch. To truly harness its power, you need to start early and stay invested for the long term. Are you ready to unlock the secret to building lasting wealth? Join us as we explore the incredible potential of compound interest and learn how you can use it to create the future you've always dreamed of. Let's start with the basics. Compound interest is the concept of earning interest on both the initial principal and the accumulated interest from previous periods. In simpler terms, it's interest on interest. This means that your money grows exponentially over time, rather than linearly. The key factor that determines the growth of your investment with compound interest is time. The longer your money has to compound, the more significant the impact. This is why starting early is crucial when it comes to building wealth through compound interest. The power of starting early. Let's illustrate the power of starting early with a hypothetical example. Imagine two individuals, Sarah and John. Sarah starts investing $1,000 per year at the age of 25 and continues to do so until she's 35, after which she stops contributing but lets her investment grow. John, on the other hand, starts investing $1,000 per year at the age of 35 and continues until he's 65. Who do you think ends up with more money? Despite investing the same amount of money, Sarah ends up with significantly more wealth than John, thanks to the power of compound interest. This illustrates the importance of starting early and giving your money as much time as possible to grow. Types of accounts for compound interest. Now that you understand the concept of compound interest, let's talk about where you can put your money to take advantage of it. There are several types of accounts that offer compound interest, including savings accounts, certificates of deposit, CDs, retirement accounts like IRAs and 401(k)s, and investment accounts. Here are several types of accounts that can help you gain compound interest. 1. Savings accounts. Savings accounts are one of the simplest ways to earn compound interest. Most savings accounts offer a competitive interest rate, and your money earns interest on the principal amount deposited as well as any interest that has already been earned. While savings account interest rates may be relatively low compared to other investment options, they provide a safe and accessible way to grow your savings over time. 2. Certificates of deposit, CDs. CDs are time deposits offered by banks and credit unions. When you open a CD, you agree to leave your money deposited for a set period of time, known as the term or maturity period. In exchange, you typically receive a higher interest rate than what's offered by savings accounts. CDs compound interest over the term of the deposit, and you can choose between different terms ranging from a few months to several years. 3. Retirement accounts, IRAs and 401(k)s. Individual retirement accounts, IRAs, and employer-sponsored 401(k) plans are tax-advantaged retirement accounts that offer compound interest benefits. Traditional IRAs and 401(k)s allow your contributions to grow tax-deferred, meaning you don't pay taxes on investment gains until you withdraw the money in retirement. Roth IRAs and Roth 401(k)s offer tax-free growth, allowing your contributions and earnings to compound over time without being subject to taxes upon withdrawal. 4. Brokerage accounts. Brokerage accounts are investment accounts offered by brokerage firms that allow you to buy and sell stocks, bonds, mutual funds, ETFs, and other securities. While brokerage accounts don't offer tax advantages like retirement accounts, they provide the opportunity for potentially higher returns through capital appreciation and dividends. Your investments in a brokerage account can compound over time as you reinvest dividends and capital gains. 5. Education savings accounts, ESAs, and 529 plans. ESAs and 529 plans are tax-advantaged accounts designed to help families save for education expenses. Contributions to these accounts can grow tax-free, and withdrawals are tax-free when used for qualified education expenses, such as tuition, books, and room and board. Both ESAs and 529 plans offer compound interest benefits, allowing your contributions to grow over time to fund educational costs. 6. High-yield savings accounts. High-yield savings accounts are similar to traditional savings accounts, but offer higher interest rates, allowing your savings to grow more quickly. These accounts are typically offered by online banks and may require higher minimum balances or have other restrictions compared to standard savings accounts. By earning a higher interest rate, your money can compound more rapidly, accelerating your savings growth. By choosing the right combination of accounts based on your financial goals, risk tolerance, and time horizon, you can take advantage of compound interest to grow your wealth over time. Each type of account has its own benefits and considerations, so it's essential to choose the one that aligns with your financial goals and risk tolerance. For long-term growth, retirement and investment accounts typically offer higher returns, but they also come with more risk. Strategies for maximizing compound interest. Now that you know where to put your money, let's discuss some strategies for maximizing the power of compound interest. Here are a few tips to get you started. 1. Start early. The most effective way to leverage compound interest is to start investing as early as possible. The longer your money has to compound, the greater the impact. Even small contributions made early on can grow significantly over time. 2. Consistent contributions. Make regular contributions to your investment accounts. Whether it's weekly, monthly, or annually, consistency is key to maximizing the benefits of compound interest. Set up automatic transfers from your bank account to ensure you're consistently investing. 3. Reinvest dividends. If you're investing in dividend-paying stocks or funds, reinvesting dividends can accelerate the growth of your investment portfolio. Instead of taking dividends as cash, reinvest them to purchase additional shares, allowing your investment to compound more quickly. 4. Maximize tax-advantaged accounts. Take advantage of tax-advantaged retirement accounts like IRAs and 401(k)s. These accounts offer tax benefits that can amplify the power of compound interest. Contribute the maximum amount allowed by law each year to maximize your tax savings and investment growth potential. 5. Diversify your portfolio. Diversification is key to managing risk while still allowing your investments to benefit from compound interest. Spread your investments across a mix of asset classes, such as stocks, bonds, real estate, and alternative investments, to reduce the impact of market fluctuations. 6. Avoid early withdrawals. Try to avoid withdrawing money from your investment accounts prematurely. Early withdrawals can disrupt the compounding process and diminish your returns over time. Instead, let your investments grow undisturbed for as long as possible. 7. Monitor and adjust. Regularly review your investment portfolio and make adjustments as needed. As your financial goals and risk tolerance change, you may need to rebalance your portfolio to ensure it remains aligned with your objectives. Stay informed about market trends and economic conditions to make informed investment decisions. 8. Seek higher returns. While it's essential to manage risk, don't be afraid to seek higher returns when appropriate. Invest in assets that have the potential to generate above-average returns over the long term, such as growth stocks, emerging markets, and small-cap equities. Just be sure to conduct thorough research and diversify your investments to mitigate risk. By implementing these strategies, you can maximize the power of compound interest and accelerate the growth of your investment portfolio over time. Remember, patience and discipline are key to long-term investing success. Real-life examples of compound interest. To drive home the importance of compound interest, let's look at some real-life examples of individuals who have leveraged its power to achieve financial success. From early retirement to funding their children's education, compound interest has enabled countless people to achieve their dreams. While specific individuals may not always disclose their financial strategies publicly, there are countless real-life examples of wealthy individuals who have leveraged the power of compound interest to their advantage. Here are a few notable examples. 1. Warren Buffett. Warren Buffett, one of the most successful investors of all time, is a prime example of someone who understands and harnesses the power of compound interest. Buffett started investing at a young age and has consistently reinvested his earnings back into his investments, allowing them to compound over time. Through his disciplined approach to long-term investing, Buffett has amassed a net worth of billions of dollars. 2. John Bogle. John Bogle, the founder of Vanguard Group and pioneer of index investing, is another example of someone who has used compound interest to build wealth. Bogle famously advocated for low-cost index funds, which allow investors to capture the long-term returns of the stock market while minimizing fees. By staying invested in low-cost index funds and allowing his investments to compound over decades, Bogle achieved financial success and helped countless others do the same. 3. Charlie Munger. Charlie Munger, the vice chairman of Berkshire Hathaway and Warren Buffett's longtime business partner, is known for his investment acumen and commitment to long-term thinking. Munger has emphasized the importance of patience and discipline in investing, allowing investments to compound over time without succumbing to short-term market fluctuations. Through his prudent approach to investing, Munger has accumulated significant wealth and achieved financial independence. 4. Peter Lynch. Peter Lynch, former manager of the Fidelity Magellan Fund, is renowned for his successful track record in the investment world. Lynch famously advocated for individual investors to invest in what they know and understand, rather than trying to time the market or chase hot stocks. By staying invested in high-quality companies and allowing his investments to compound over time, Lynch achieved impressive returns for himself and his investors. These are just a few examples of wealthy individuals who have benefited from the power of compound interest in their financial journeys. While each person's path to wealth may be different, the underlying principles of patience, discipline, and long-term thinking remain consistent across their stories. Whether it's through consistent saving, smart investing, or a combination of both, compound interest has the potential to transform your financial future. By starting early and staying disciplined, you too can harness its power to make your money work for you. As we come to the end of our journey, remember this: compound interest is not just a financial concept, it's a game changer for anyone seeking to build wealth and secure their financial future. By harnessing the power of compound interest, you have the opportunity to turn small investments into significant wealth over time, but it requires patience, discipline, and a long-term mindset. Whether you're saving for retirement, funding your children's education, or pursuing your dreams, compound interest can help you achieve your goals faster than you ever thought possible. Thank you for joining us on this journey. If you found this video helpful, don't forget to like, comment, and subscribe to this channel for more insights on wealth creation and financial success. And remember, the power to create the future you desire lies in your hands. Start investing in your dreams today.